Welcome to the Chrisman Commentary Daily Mortgage News Podcast. I'm your host, Robbie Chrisman. Topics on today's episode include a look at tappable equity, my interview with Wholesale Mortgage Direct's Denis on the evolving wholesale channel and HELOC landscape, the rise of digital lending, investor and borrower demand in underserved markets, and how the MyEQNow platform is reshaping access with innovative data-light solutions. And we're seeing falling existing home sales actually increase inventory. Thank you to Wholesale Mortgage Direct for sponsoring today's podcast. Their mission is to deliver high-demand, innovative products unique to the wholesale industry, including MyEQNow, which is a one-of-a-kind traditional HELOC platform. Looking for innovative HELOC, non-QM, and or reverse options? WMD is your trusted partner. July 24th. While much of the nation swelters, it's summer, right? If you live in Utah, it's Pioneer Day. Pioneer Day. The average home in Utah now costs about $517,000, a 1% increase from last year, and very manageable if I do say so myself. In terms of state-level fraud rankings, Utah steered clear of many mortgage scams, which is good news. But it actually also ranks high in people who live at home with their parents. Approximately 39% of 18 to 30-year-olds in the U.S. lived with their parents, according to a post citing OECD data. The share of U.S. homeowners without a mortgage rose from 33% in 2010 to 40% in 2023. Turning to the what's moving or not rates world, it's kind of an odd way of phrasing things. The 5-day rally in the bond market may be over, but the bear flattening of the yield curve yesterday wasn't driven by a tremendous amount of selling. Sure, there were some technical pivots and money being taken off the table in general, but pressure was mitigated by news of a trade deal with Japan. Does that mean they don't have to release the Epstein files now? I digress. The trade deal imposes a 15% tariff on Japanese exports, lower than the previously threatened 25%, while Japan committed to investing billions in the U.S. and opening its markets to more American goods. That deal, with reports that the European Union and the U.S. are progressing toward an agreement that would set a 15% tariff for most products, according to diplomats briefed on the negotiations, helped fuel a risk-on trade and midweek action. As global trade tensions ease and attention turns to corporate earnings from Wall Street, other countries like the Philippines have made modest progress, while Canada faces delays. The reported progress on the trade front has lifted risk assets and put slight downward pressure on treasuries, though the 10-year yield remains anchored near its 200-day moving average. Despite trade optimism, the Treasury market continues to trade within its established range, and that pattern is unlikely to shift in the near term, barring a major surprise. Put a different way, markets are more likely to lean toward lower yields than a breakout above 4.5%. But nobody can predict rates. For today's interview, I wanted to welcome to the show Wholesale Mortgage Direct's Denis to talk about the evolving wholesale channel and HELOC landscape, the rise of digital lending, investor and borrower demand in underserved markets, and how the MyEQNow platform is reshaping access with innovative data-light solutions. He's Chief Lending Officer at Wholesale Mortgage Direct, which, if you've been listening to the podcast all week, this week, their mission is to deliver high-demand, innovative products unique to the wholesale industry, including MyEQNow, which is a one-of-a-kind tradidigital, it's an important distinction, HELOC platform.
You're the CLO of MCM, and today we're going to focus on their wholesale division, Wholesale Mortgage Direct, which combines traditional and digital on the proprietary HELOC platform, MyEQ. Now, I want to start this discussion like I've started plenty, and that is, can you kind of bring people up to speed that may not be intimately involved in it? Because the HELOC landscape is kind of going gangbusters right now. Definitely a good place to be, but like I said, for those not intimately involved, can you kind of bring people up to speed?
Sure. So I'd say higher level overall, HELOCs represent about a little bit over $5 billion in originations in May of 2025, which is quite a big increase over May of 2024 of about 30%. As everybody knows, when you have persistently higher interest rates, there's going to be more of a demand in HELOCs. But what I'd say is that specific in our space, we represent less than 10%. When I say we, that'd be mortgage banks and mortgage brokers represent less than 10% of the overall originations, whereas the depository banks represent over 90%. In contrast, closed-ended first, or probably closer to 70%, are done by mortgage banks and mortgage brokers. So we're a lot lower percentage-wise in the HELOC space versus in the closed-end first. I expect over time there'd be more of a stabilization where that number is going to be a lot higher. So with that, or that percentage is going to be a lot higher. With that said, whether rates go down or up, HELOCs in our space for mortgage banks and mortgage brokers is going to continue to increase. So to give you perspective, with that over $5 billion in originations in May, that makes that space in all very close to the size of a non-QM originations. So it's a very large amount of originations that are being done with HELOCs.
Again, we had mentioned offline that the landscape is changing. It's like depositories used to dominate. Now we're seeing the rise of digital lenders. And in addition to that, people don't realize this. There's $14 trillion of home equity that's tappable out there. It's a massive, massive market. You're talking multiples of annual first lien mortgage originations in terms of market size, and also a huge market versus non-QM because the industry is focused on non-QM. But the HELOC space is a huge multiple of that. I'm wondering if you could speak a little bit to kind of the changing landscape that we're seeing here.
Yeah. So overall, there are variables that are out there, market forces that are helping the originations go up in the HELOC space. And as you mentioned, the trapped home equity somewhat approximate that at about $35 trillion. But there are other variables that are out there that are driving the originations. One of them is that 60% of the first mortgages out there are under 4%. Another thing is that credit card debt is at an all-time high at 1.2 trillion. And typically credit card debt is over 20%. And then you did mention the digital HELOCs, which is something unique to our space. The digital HELOCs are taking off. One of the kind of constraining factors with the digital HELOCs is because you live by the sword and you die by the sword with the digital. If it's not straight down the middle, being the borrower and the qualification, then it's hard for them to qualify. So in our space, one of the things that we have that is a bit unique versus the depository banks is that we can offer products that they either can't or won't offer. So something that we looked at the market and saw a huge need is to take the strengths of a digital platform where you can automate a lot of things, whether that's pulling credit, AVMs, and so forth, but also apply some of the skill sets that we have on the traditional side where you have credit experts that can review certain things that maybe it falls off the conveyor belt with a purely digital platform. We can look at it and say, okay, in this case, I'll give you an example. With the digital lending, if you have an AVM that doesn't work, that might be the end of the story there. Whereas with something that combines traditional and digital, if the appraised value you suspect is higher than the AVM, that's something that you as the originator can work with your borrower and say, look, we'd rather go with an appraisal versus an AVM. So what I call that is optionality. With originators nowadays, if you have optionality, you can significantly increase your funding ratio substantially, like 4x, versus only using a purely digital HELOC platform. So the space is evolving. The digital players are great. You can get these loans done very quickly. But if you combine something that has the higher funding ratio of traditional, and then we call it tradigital, by the way, and then some of the automations and technology gains with digital, you end up with an overall platform with a much higher funding ratio, and you still have a lot of that speed and convenience where you're talking days to fund and not months for sure, not weeks, certainly.
That's pretty neat to hear. I still get the sense, though, that it's an underserved market, even with companies competing for that market share, even with the demand we're seeing amongst borrowers. I mean, whether it's REO, self-employed, there's a ton of borrower demand out there. I'm hoping you can speak to that a little bit, as well as investor demand for these products.
Yeah, I'll take that one at a time. We'll start off with the underserved market. It's a substantially underserved market, similar in a way to alt-doc and non-QM, where traditional banks probably can't fund those type of borrowers for various reasons. That's the same thing in the HELOC space. When you have borrowers that are self-employed, the way that funds go through their bank accounts and tax returns, et cetera, oftentimes we all know they're not going to qualify, which we would traditionally call a conventional loan or conventional underwriting. In that case, something with it's the same with a digital there either, because tradition in a sense, but what digital HELOC lenders are looking at is your personal bank statements, and they may be looking at how much you're depositing into your personal accounts. Well, we all know that many self-employed borrowers, especially small business owners, aren't flowing a lot of money through their personal accounts. So going through a digital underwrite, they may not qualify. But if you go through a strictly conventional underwrite, they may not qualify either. So there's this huge underserved market of self-employed borrowers, which could be considered alt-doc, that we've combined some of the non-QM factors. Like what we can do is we can look at 12 months bank statements for income. And what we've done in this case is we've added a digital element where we don't need the PDFs. We can use a service that is through a strategic alliance in partnership with Greenline. We can pull the source data directly from their bank account and do a bank statement loan without the bank statements themselves. So we can qualify using the 12 months information from their bank statements. And that's an underserved market that the depository banks currently can't fund. And the digital lenders have a very difficult time funding those type of borrowers. And then additionally, what you had mentioned, REO and real estate investors, traditional underwriting, if you're looking at their if you're looking at their tax returns, they may not qualify. Well, we can use an alt-doc type of qualification where we can wash the PITI, for example, by just a few months proof of receipt of rent. There's all sorts of little tricks that we can use with that credit expert in the loop. Whenever the loan comes in, somebody reviews it, says, hey, how can I get to a yes? That's how we're looking at it, Wholesale Mortgage Direct. Now, you did ask also about investor demand. And what I'd say to that, it's insatiable. The secondary market, capital markets, can't get enough of this paper. The issue that they're having is they're having a difficult time finding originators that can effectively manufacture these loans. These loans are different than your closed-end mortgages. For example, they're not governed by TRID, different sets of closing docs, different servicing expectations. So I know one investor that's hugely bullish on the market overall for seconds, but they pulled out of it because they just couldn't get the right quality of loans inside their door. So when they come across a company like ourselves that can economically originate these loans and deliver the quality paper, they're super excited. So everyone out there, when I raise my hand with any capital market and counterparties, they're very excited to buy this paper.
But then I know there's excitement out there because didn't you recently partner with JP Morgan, which I was going to ask you about, had their play for charging for consumer data, which might be a whole different discussion, the value of data that the mortgage industry possesses. But you did partner with them recently, correct?
Well, what I'd say to that, I'm not going to get into specifics to our counterparties, but I know JP Morgan does like to buy this paper. Later we can talk about some of the things that I think you may be interested in as far as some of the bank-to-bank related payments and things like that, and JP Morgan raising their hand about how there may be fees associated. But that's truly probably not going to affect us too much. That's more for like the Cash App and Venmos, where those payment types are affecting some of their bottom line card-related revenues. Fintechs like we consider ourselves, the Plaids, Finicities of the world, they're already paying for permission consumer data. So Jamie Dimon doesn't seem to be interested in getting in our way of accessing consumer data as long as the borrowers know what they're providing access to. In fact, because the alternative to that is people downloading bank statements and things of that nature, which is ripe with fraud, higher friction, et cetera. So seemingly as it stands right now, the Financial Technology Association filed a motion summary judgment defending this rule, basically getting the free access. And I don't think JP Morgan's going to cause a stink to that because that would only hurt their customers. But it's more related to, like I said, the Cash Apps and the Venmos that are cutting into their revenues.
There you go. Well, I'd be remiss if I didn't ask a little more about what you are doing. Very congratulations to you on JP Morgan buying some of your stuff. But I've been mentioning all week on the podcast this MyEQNow platform, which I don't want to oversimplify it here, but it caters to bank statement loans without source data. You can talk about the platform in general and kind of elaborate on what I just mentioned there about those banks.
Yeah, so MyEQNow, what we looked at is how can we economically manufacture these loans? When I say economically, that's for the originator, whether it's the independent mortgage bank or the mortgage broker, as well as us as a wholesaler, because that's the $1 million question is if you have a $125,000 bank statement loan, how can you get that through where it makes sense for everybody? So we broke down the industry, and the first thing we realized is don't do things the way the industry's done it in the past. There's a lot of what I'd call legacy processes and legacy infrastructure, which makes it impossible to originate these loans economically. So what we developed is more of a thing where we're going to automate a lot of things that otherwise you'd have to do manually, such as maybe some of the credit reports and AVMs. Then other components, we're going to have our processing people take care of it for our counterparties, call it the brokers. And with the bank statement loan specifically, we have a platform, a point of sale. So if you'd like, as a mortgage broker, you can email out a link and you have a professional HELOC website or point of sale where your borrowers can very simply enter their information and we can start the application and the manufacturing of the loan. What we do in this sense from there is after the loan's approved, either you as the broker can upload whatever conditions we have after the conditional loan approval, or your borrower can do it. But the way we've designed the system, the underwriting guides, the average loan approval is coming out with only 5 conditions for which they would be responsible. So these loans are flying through the system because we've put up the front, up front, we've built systems to make certain we have quality loans going in. We made it such that what I call how the sausage is made, there's a lot of things that go on in the background, but we're not necessarily pinging the borrower or the broker with a lot of the processes that we're doing, our internal processes. A lot of those, like I said, are automated. And when they're not, we just do those behind the scenes to keep these loans speeding through. We kind of compare it to going down a water slide. You don't stop halfway down the water slide. It's the same thing with our HELOCs. Once you go down that water slide and that loan's submitted for approval, we want to get to funding, to docs and funding as quickly as we can. So with our white labeled site, with the way that we do compensation, we do compensate our broker partners up to 250 basis points. So if you look at the value prop or the overall proposition of what we're offering, funding a $200,000 HELOC could make you $5,000 for a minimal amount of work. A lot of the borrowers that you've probably funded loans for in the past do need access to financing for the equity they have in their house. So this is a great product to offer to them. Additionally, what we've realized is if you don't offer HELOCs or closed-end seconds as well, which we also offer, those borrowers are going to go somewhere else, whether it's a bank or to the broker down the street. And then you're left in a position where you may not be able to retain your clientele when they do a purchase a year or two from now. So it's not only that you can make money today in a relatively low friction environment, you also get to retain your clients and borrowers for life. So overall, it's just a very plug and play, purposely plug and play system that we've developed. I always have to remind people it is still mortgage banking, and every loan, every HELOC is like a snowflake. Each one's a little bit different. And that's why you have our partners in the background, the credit experts, always collaborating with you and asking you, how would you like to structure this? If you're okay with X, let's move forward and let's get this thing to docs. But if things are a little bit more complicated, or maybe somebody owns 6 properties and they didn't collect rent on one property for 2 months, whatever that X variable is, we're going to address it. We're going to address it quickly and honestly, and always try to keep the borrower involved in the process where necessary. We want them to understanding the product that they're going to be funding.
Yeah, in this age of the recapture arms race, if you will, it seems like a no-brainer for companies to have an offering like this, and it's neat to you white label things. I would add as well that, and I'm sure mortgage lifers are going to roll their eyes at what I'm about to say, but I would say the future is now, old men and old women, that whether it's hard money lending, whether it's the HELOC space, I think we're starting to see new avenues where companies can figure out how to maximize speed when it comes to closing. Like I said, I think mortgage lifers will roll their eyes at me saying that, but it is what borrowers are demanding, and we need to find a way as an industry to get there. So it sounds like the HELOC space is pioneering things, and that's actually a good segue into the final thing I want to ask you here, which is I will ask you to pull out your crystal ball a little bit. How do you see the space evolving? And that's a very broad question. You could talk about time to close. You could talk about investor demand or borrower demand. You could talk about product proliferation. But it's kind of how do you see the space evolving now that public acceptance has come a long way and there is demand from all sides of the equation?
Yeah, so I see it evolving in many different forms and fashions. One, there's going to be innovation in this space, and I can give you some ideas where I think that's going to go. But the idea of somebody having to go to a bank, order an appraisal, spend 45 days, give them loads of paperwork for a HELOC, those days are gone. So what we're trying to do is design something, speed and convenience, but also, as we've always done as mortgage banks and mortgage brokers, we've eaten into the competitiveness against the depository banks too. So I can see there being innovative products that come out that maybe today our rates may be a little bit higher than what a depository bank would be. But a year or two from now, I don't see that happening. HELOCs, there's also a lot of interest in first lien HELOCs. So maybe you want some of the flexibility of a HELOC and you don't want to close in first lien. That's a space that's becoming very popular. And overall, again, knowing that we're less than 10% of the overall originations of the HELOC market, even if the overall HELOC market were to decline a little bit, as our percentages go up as independent mortgage banks and mortgage brokers, there's going to be more volume. So the future of this, I see a lot of innovation. I see a lot of technology integration and a lot more production for mortgage brokers and for mortgage banks that embrace it. It's not a difficult process or a platform to embrace if you always stay on the forefront. So that's my mini crystal ball, if you will, Robbie.
No, I love it. People can't see I'm smiling over here as you say that. Exciting times. It's kind of like stick or carrot. The horse is going to get there one way or another. Nice to see you leading with the carrot rather than the stick sword thing. Always a pleasure talking to you. Thank you very much for your sponsorship this week, and I look forward to more discussion soon, especially like you mentioned about maybe some more things with JP Morgan and consumer data. But thank you very much for the time.
All right. Thank you, Robbie, and thank you to all the listeners of the Chrisman.
Originators know that high interest rates, compared to 5 years ago, remain a significant constraint on home sales. Total existing home sales fell 2.7% in June, bringing the pace of resales to a 10-month low of 3.93 million units. The persistently weak pace of sales has allowed supply to increase recently, which has led to a moderation in home price appreciation. Despite all that, for-sale inventory remains low enough to keep upward pressure on prices. During June, the existing median home sale price climbed to $435,000, a record high. The increase is a reminder that, in addition to financing costs, elevated home prices are also a significant limitation for home buyers. Oh, I thought rising credit score costs were the reason nobody could afford a home, based on all the grousing. Today's economic calendar kicked off with weekly jobs claims in at 217,000, and later today brings S&P Global Flash PMIs for July, new home sales for June, Kansas City Fed manufacturing for July, Treasury announcing auction sizes for month-end supply, before actually auctioning $21 billion of new 10-year tips, and Freddie Mac's primary mortgage market survey. Also, the European Central Bank was out with its latest monetary policy decision, no change, and earnings continued to pour in from Wall Street. We begin Thursday with agency MBS prices slightly worse than Wednesday's close, the 2-year yielding 3.92, and the 10-year yielding 4.43 after closing yesterday at 4.39%. Let's wrap up with a joke and some housekeeping. A conspiracy theorist dies and goes to heaven. When he arrives, God says, "Welcome. You can ask me one question. Anything you want." The man says, "I need to know, who really shot JFK?" God says, "Lee Harvey Oswald shot him, and he acted alone." The man pauses and then says, "Wow, this goes even higher than I thought." Thanks again to Wholesale Mortgage Direct, whose mission is to deliver high-demand, innovative products unique to the wholesale industry, including MyEQNow, which is a one-of-a-kind traditional HELOC platform. WMD is your trusted partner for innovative HELOC, non-QM, and/or reverse options.